Welcome to yet another webinar from FP&A Professional Institute. Today's topic is probably one of the most requested topics among the list that we usually get from everybody. What I'll do just before starting is I'll just mute everybody so that there's no background noise. What I wanted to ask you is how many of you perform variance analysis on a month-on-month basis? Type me in the chat box. So how many of you are already doing management reporting and doing monthly variance analysis commentary? Type me in the chat box. Okay, so I think very common function for any finance or FP&A people to be able to get insights from the monthly report and be able to present that in a manner that business can take decisions. Okay, so I think most of you will find a lot of value in today's session. Before we get into the session, what I'll do is I'll just quickly what we'll do is before getting into the session, I'll just give a quick background about what we do at FP&A Professional Institute. And as you know, we have started training. Dhaval started his online program back in 2018, which was the FP&A Foundations. More than 2,500 people have taken that program on Udemy with a rating of more than I think four out of five. And in 2022 is when my first book was launched, which you can see in the background somewhere, which is all about FP&A. Again, it got a very good response, and I think it has sold more than 3,000 copies by now. That's when we came together for the FP&A trainings, and me and Dhaval collaborated for the FP&A masterclass, where we combined our experience. Very recently, we just started the 15th cohort of FP&A masterclass. So we've been doing this over 2 years now. In 2023, we went into this full time and started more programs on the self-paced version of the FP&A classes and financial modeling for FP&A. 2024, we launched our 6-month FP&A certification called Certified Global FP&A Professional. And also very recently, just 2-3 months back, we started a program on AI for finance and FP&A. Also, I completed my second book, which was launched back in July 2024, which has also sold more than, I think, 1,500 copies by now. So is my audio
Yeah.
clear to everybody, or is it not very clear?
Now we can hear you, sir.
Well,
Probably have to take the mic closer.
So over the last, I think 5 years, we have trained more than 3,000 students across these programs. And what we'll do is we'll quickly cover the today's roadmap in the next couple of minutes before we get started with the session. Okay, so what we'll cover today is we'll talk about variance analysis, what and why variance analysis is important. So that is what we are going to start with. Then we'll cover a very interesting framework, which is called the DERP framework, which will help you to come up with variance commentaries that you can consider as to be very actionable. People can relate to that on the business side and take actions. Then there's one technique, which is, I'm sure some of you may have already heard about this, the 5 I technique of understanding the root cause of any variance. We'll talk about that. And if time permits, we will also talk about some AI use cases for variance analysis. So this is what we have in plan for the next 60 to 90 minutes. And what we will do is we will take questions if there are any questions at the end of the 60 to 80 minutes of the session. Okay, so with that, what I'll hand it over to Dhaval for the key activities in FP&A.
Thank you for the introduction. So what we'll do is, I mean, most of you could be at different levels in your careers. Some of you may have seen FP&A elements, some of you may not have. So please be a little bit patient with us. We'll try and cover as broad the spectrum as possible so that all of you get some or the other takeaway from this session. And also, please do stay through till the end, get rid of all the distractions for the next 60 minutes or so. We will be doing activity at some point in time, which is an Excel sheet where you need to look at the variances. If you can, then try and join through your laptops and then participate. Just focus on the training, and we'll do a debrief, and then you will be able to understand the case and the exercise that I'm sharing. Okay, so when we talk about FP&A, right, so there could be a number of different small set of activities that FP&A teams carry out. But out of that, these 4 activities are some of the core set of activities that almost every company does it in some form or the other. And these are budgeting, forecasting, And under management commentary, profitability analysis and variance analysis. Now, budget is preparation of an estimated plan, business plan, budget for the next financial year. Forecasting is tracking the financial performance during the financial year. Now, let's say 3 months of actuals plus 9 months of estimates, or let's say 6 months of actuals plus 6 months of estimates, right? So that is the forecast. And profitability analysis could be different levels of profitability. It could be branch level, product level, business unit level, depending on what kind of a company you're set up with. And then variance analysis is all comparisons, right? Comparing actual versus budget, actual versus forecast, current quarter versus previous quarter, current month versus previous month. All of those different kind of comparisons come under the variance analysis bucket. So what is variance analysis? Budgets, as we know, represent the plan for the year, right? It's an estimate, it's a blueprint for the upcoming financial year. Whereas forecast is actually a combination of actuals for the periods that are already completed in the year and plan or estimate for the balance period of the year. Now, let's say if we are talking about 3 months of actuals and 9 months of estimates, it is generally called as a 3+9 forecast, where we have 3 months of actuals and 9 months of estimates. Now, senior management, right, they are always impatient. They always want to understand one point, which is, are we on track? Are we on track to achieve the plan? Are we on track to achieve the forecast? Comparison between plan versus actuals, forecast versus actuals comes into play. And when you compare plan or forecast with actuals, you will have to ascertain the reasons for the variances. And there'll be some variances, right? So sales has gone up or sales has come down, cost has gone up or cost has come down. So there'll be some variances. And you have to ascertain the reasons for these variances as to why there is a lower revenue, or why there are higher costs, or why did we miss a certain target, or why did we spend higher amount. Is this a timing difference or is it a permanent difference, right? Timing difference is something which will get adjusted in the upcoming periods, right? All of these reasons you will have to find out. And the management is interested in business reasons. They are not interested in accounting reasons that we under accrued last month, now we are over accruing it this month, or we over accrued last month, so that's why we reversed it this month. That's all your accounting problem, right? So the management wants to know the business reasons behind this. Why is there lower revenue? There is lower revenue because we lost some sales to the competitor. This competitor hijacked our sales with some attractive discounts, right? That is why there is lower revenue. Now, this is a business reason. And you can ascertain these business reasons only if you have strong cross-functional relationships and you're able to go ahead and talk to your business teams and understand what's happening on the ground, right? So the management is always interested in business reasons. So why variance analysis is important? It will help you understand the reason for deviation. Is it permanent? Is it temporary? Can it be reversed? Can it not be reversed? And take corrective steps accordingly. Should we increase the price? Should we decrease the price? Should we increase the promotions? Should we not hire somebody? Should we go ahead and expedite the hiring? Whatever the corrective steps is, you can take that. Activate plan B if required. Let's say when you started the budget or the plan for the financial year, you thought product A would be great, right? But one quarter into the year, you see that, okay, probably product A is not doing well. Should we switch to product B, right? So you can activate that plan B, and also helps you in better cash flow planning, right? So if there is a huge variance in certain months due to peak seasons, you collect more cash, right? That can help you manage your off season as well, right? So cash flow planning is something which variance analysis can help you with as well. So these are the 4 broad reasons why variance analysis is super important. Now, what is your role in variance analysis as a finance professional or as a FP&A professional? First thing is that you will have to liaise with the business teams to understand the reason for the variances. Okay, and I'm giving you a oil and gas company example here, where let's say there are 3 business units in this oil and gas company: aviation fuel, gas, and lubricants. Now, you could be part of a central finance team where you're listening with the business teams and trying to understand the reason for these variances. Or you could be part of an embedded finance team where, let's say, if you're FP&A analyst aviation or FP&A manager gas, you will internally discuss, ascertain the reason for the variances, and then provide it to the central finance team or the FP&A team as the reason, right? Depending on how your company is structured, right? And these reasons for variances could be a fall or increase in revenue. Is it a price variance? Is it a volume variance? Reason for drop in margins, right? Did we give more discounts? That's why the margins have dropped. What are the reasons for increase or decrease in overheads? Did we expedite some marketing spend, which is not going to happen later on during the year? There could be a timing difference, right? All of these kind of different reasons you will find out and then you come up with management commentary on a monthly basis or on a quarterly basis. You will be producing these reasons through a management commentary, right? Now, this management commentary could be probably a 10-page dashboard, or it could be just one small snapshot, depending on how complex it is and where you are reporting. If you're reporting to a mid-level manager, then they might want to see details. If you're reporting to a high-level board or a CFO, they might want to see just broad variances, broad set of variances, right? And to ascertain these variances, you will have to always do a lot of comparisons, month on month, year on year, quarter on quarter, right? Plan versus actuals, forecast versus actuals, rolling forecast versus actuals, all of these different kind of comparisons, understand the reasons for these variances, and then also provide some recommendations as to how you can reverse these variances or how you can negate these variances if they are unfavorable variances, right? So that's what your role in variance analysis is. Now, how do you find these variances? And also, after you find these variances, what needs to be done, right? To simply explain the action points or the variance analysis concept work is something which is very useful, very simple to understand. Now, what is this DERP framework? Okay. First of all, we have to define the variance. Is there a variance? Is it favorable, unfavorable, right? Is it temporary? Is it permanent, right? Then explain the variance. Try and understand the reason behind this. Is it a pricing difference? Is it a cost difference? Is there an exception approval for the extra cost that we spent in this quarter, right? Try and explain the variance behind it and the business reasoning behind it. Then recommend actions. What happens? How can we reverse this variance? If it's a temporary variance, then how do we reverse it? Okay. Do we increase our prices? Do we increase our discounts to increase our sales? Whatever may be the recommended action. And then analyze the impact of your recommendation for the rest of the period, right? It could be, what's the impact of it in the coming quarter, or what is the impact of it over the rest of the financial year, right? And this simple 4-step formula or a framework, right? Defining, explaining, recommending actions, and projecting the impact is called the DERP framework. So whatever variance you're looking at, right, you can apply the DERP framework, and it makes it very simple for you to come up with a commentary as well as certain recommendations for the management. Now, let's look at some examples on this. Suppose there is a 15% unfavorable variance in cost of goods sold. Now, what is unfavorable variance? Which means from whatever we had planned, or let's say in this case, it is comparison from quarter to quarter, from compared to the last quarter, the cost of goods sold has increased or is higher by 15%. Right? So that's the 15% unfavorable cost of goods sold, primarily driven by supplier price increases, or suppliers increase the prices of raw materials, whatever it may be due to the market factors. We recommend exploring either alternative suppliers or renegotiating terms or looking at substitutes of the products with an anticipated 5% cost reduction projected for the next quarter. Next quarter's cost of goods sold will be 5% lesser than what it was this quarter because of our actions. Right? Now, how do you deconstruct this commentary into the DERP framework? And you will notice that to provide this commentary, the DERP framework has been used. First, we try to define the variance. Right? The variance was 15% higher cost of goods sold compared to the previous quarter, but it's actually compared to the previous quarter. Driven by increase in raw material cost from supplier price hikes. And we know that the supplier price, raw materials we had estimated at a certain price, but the supplier charged higher prices, maybe due to some market factors that were uncontrollable. Explore alternative suppliers to negotiate better. Are there any other alternatives? Can we consolidate something? Can we go back to some other supplier? Can we develop a backup supplier? Right? And what is the potential impact? The potential impact is that we are aiming to reduce 5% or improving the cost of goods sold by 5% compared to the current quarter. Right? So this is how you can construct any commentary by using the DERP framework. Now let's look at one more example. In this case, it is a revenue example. Suppose there is a 12% unfavorable variance in revenue, which means there is a 12% drop in sales compared to the previous quarter, caused by lower sales volume due to heavy competitor discounts in key markets. You ascertain the business reason. Heavy competitor discounts in key markets, in our key locations, where our product is supposed to be strong. Competitor used some discount strategy, and then he hijacked our sales in those key markets. Right? We recommend enhancing promotional efforts in the key markets with a projected 8% improvement in revenue for the next quarter. First, we try to define the variance. 12% unfavorable variance in revenue or drop in revenue compared to the last quarter. Due to heavy competitor discounts, we explain the variance, then we recommended to adjust the strategy of promotions, enhance our promotions in these key markets. And then we are now projecting a 8% improvement in the revenue in the next quarter. So again, DERP framework in action. So this way you can use any examples. Typically in our larger format 4 weeks courses, we kind of explain at least 8 to 10 different examples on using this framework, right? And there are umpteen examples and case studies available for this as well. So, but this is what we wanted to cover, so that DRP is a very simple framework. You can apply it in case of any variances, whether it is revenue, expense, or or any other variable costs, any other concepts, any other costs that you want to look at. You can apply the DERP framework and deconstruct it and provide your commentary. Okay. So now what we'll do is I'll take a quick 30-second pause to see if there is any comments. We can take questions in the end, otherwise it will break the flow. So just stay with us for some time. What we'll now do is quickly do an activity. So those of you who are logging in from your laptops, you will probably get a chance to better participate in this. I'll share with you a variance question. Yeah.
One thing I want to add is not for every variance you'll do the all four. So this is the complete framework, but you can at least to define, explain for all the variances, and for variances where you have a recommendation and where you can do a projection for the future period, you can do a projection as well. So D, E, and E will be for every variance analysis that you do. R and P might be depending on the situation. If you have a recommendation that you want to give, then you will add the R and the P.
So now what we do is we'll get into a quick activity. I will just put a file in the chat box, an Excel file. On sheet 1, there is a quick table on the variances. And then on sheet 2, there is a detailed trial balance of budget versus actuals. And there are some commentaries, some maybe reasons as well. So what you'll have to do is you'll have to see those and come up with your set of commentaries on sheet 1. Okay, let me show that to you first before putting it in the chat box. Okay, let me share my screen. Okay, so this is how the file will look like. You have your June month forecast and you have your June month actuals. There are some variances. And on sheet number 2, there are some detailed commentaries, and look at row number 322 onwards. So 322 onwards, there is a trial balance. There's a detailed trial balance P&L that you will see. And then there are some commentaries as well. Assuming your team of FP&A analysts have kind of come up with certain reasons for these variances, you have to understand those variances and come up with your explanations. And this report will be sent to the branch head or to the business unit head. Okay, so you have to be crisp in your commentary. Yeah, so that is what is expected from you. Okay, I'm sharing my screen and we can get directly into the debrief. Okay, so this was the example given to you, right? So we had June month actuals, okay, and June month forecast. We had 17 million of revenue and there was 17.5 million of forecast, right? Some compensation expenses and some OPEX expenses. Yeah, and then there was operating profit. Now a quick question to you for which I want you guys to respond in the chat box. Can I write no major variance? Can this be my commentary for the revenue line item? I need a yes or no in the chat box. No, yes, never. No, yes. Is that half of you are saying yes, and probably more than half of you, are saying no, right? Now, always remember that when it comes to variance analysis, by just looking at the face of it, you can't decide whether there is a variance or no. So the answer to this is not, we cannot put no major variance here, right? Even if the amount is low, even if we have exceeded our revenue target, which is a great news, okay, but this still doesn't serve the purpose for management to understand. So what can be done here? Now focus on the solution. Don't type into the chat box anything, just focus on the solution. I'm now sharing some responses in the chat box. So I've got some sample commentaries here. I'm not saying this is exactly what you need to write. I'm just saying some indicative commentaries. You feel free to write any better commentary if you want, or if you want to capture any detailed commentary. But the scenario warranted a crisp commentary because we are sending it directly to the business lead. Also, we should disable annotations. So in terms of revenue, right? So there is higher revenue mainly due to additional projects from client X. offset by lower revenue from client Y. So what is happening here? So if I say no major variance, the business lead will not come to understand, right, that client X, there was a revenue that we had projected and it is down by 350K, whereas client Y, for which we had projected the revenue is down by 333K, but client X has surprisingly spent more time, okay, and has more budget with us, and then he has given us a revenue of 350K extra. So luckily, in this quarter, we are not missing our targets, and in fact, we are able to slightly exceed our targets by 17K. But is that a good thing? Yes, there is one thing that we all need to get into the details of it is what happened with client Y. Why did it not work? Or why did he reduce the spending with us? Right? That is a question that the business head needs to ask, and we might need to find details about it. In terms of compensation expenses, yes, there is a saving of 143K, but this is more of a timing difference. There are some unclaimed fringe benefits for which we have provided for, or maybe not provided for. So the employees can claim these at a later date during the financial year. So let's not get very happy that we are saving 143K in the current month. Then there is other OPEX expenses. Here we see some tangible gains, right? Forex gain of 550K. Now, this is again not in my control, right? Unless you are actively involved in hedging and there is a plan. But still, there will be some Forex gain or loss because it still can't be 100% accurate, right? Interest income from corporate treasury. Now, in this particular organization, interest income was included as part of operating income. Now, in some cases, they exclude interest. Whatever is coming from the operations can only be operating income. But in this particular company, interest was included as part of operating income. Savings through intercompany recharge from UK. We used to take some services from UK. Okay, maybe in this month we have taken less charge by our holding company or a group company. And then there is miscellaneous variance of 18K. Yes, there are some more variances of, let's say, 30, 40, 50K as well. But because I have to explain 1.5 million of variance, right? So those 40, 50K variances, I can just combine it and say miscellaneous variance of 18K. However, you're free to add 10 more line items as well. That's absolutely okay. And then because of this, higher profit is mainly due to lower staff cost and OPEX expenses because revenue has been flat. So that's the impact on the profit. Now, this is a sample commentary, very simple exercise, right? Now, on your day-to-day job, the commentaries might be much more complex, but actually when you try to dig these kind of variances, you will have to probably go deep into understanding why this variance has been there, right? And get some background about it. If some people have not claimed their fringe benefits, how many people have not claimed their fringe benefits? When are they going to claim? All of these kind of reasons you may have to probably find out and keep them ready when you're explaining the variances. Okay, I hope this short exercise gave you some quick glimpse of a month-end variance analysis exercise. Asif, you want to just put some concluding thoughts on this and then move to the next section of the training?
Yeah, so one thing I wanted to also again repeat is that a lot of people, when they are new to FP&A, they think that they are alone responsible for doing the variance analysis commentary. So that is not the case. You are responsible for collating the commentaries and then presenting it. The responsibility of providing you the answers or the comments is also on the business side. So you have to reach out to your teams, business teams, cross-functional teams, and understand from them what the variance analysis reasons are. And we'll talk about one of the frameworks in the coming slides on that. Let me go to the next part where we have some more tips, some more tips on analysis. Let me share my screen. One thing is that you should not assume that a variance is good or a bad variance just based on the surface level look of it. If it is a cost variance and if you have overspent money, it is not necessary that it is a bad variance. It might be a good variance also in a situation where that extra spend is bringing in some extra revenue or is going to help you in certain way that it is good for the business. So it's not, don't assume that a variance is a good or a bad variance just looking at the face of it. Also, you should analyze each and every line item at a team level. In cases, it might be a department level, it might be cost center wise. So one cost center expenses might be offset by the other cost center. One team's expenses might be offset by the other team. One department's revenue might be offset by the other departments. So you have to look at it at a granular level and then decide on the commentary. If you're looking at expenses and if you identify that the expense has been overspent or you spent a lot more money than the budget, then you can recommend the teams to cut back to spend less in the next period. And unless there is a reason to continue to overspend, you should suggest that you had a budget of say $1 million for the full year. You've already spent in the first 4 months, so you should now stop spending that much. You should cut back and you should make sure that you are on the track for the annual your year-end budget. When you do this, when you ask questions and when you take commentaries and check reasons for the variances, you create that discipline and awareness among the different business teams. And that is what also helps them understand that, okay, somebody is checking and somebody is asking me questions, so I'll have to follow the budget. I'll have to follow whatever the goals that were given to me in the beginning of the year. Also, you can identify any team or any department who is doing well in the team, and then use that as a case study so that other teams can also follow. So you can reward some teams, some business units who are doing well, and that can become an example for the other teams and the other business units to follow in the company. Okay, three questions you should ask once you have done the DERP framework. So when you describe the variance or when you write down the variance, you follow that framework, which is describe, explain, and recommend and project. So after you've done that, these are the three questions that you should ask every major variance that you are doing commentaries. First question is why did this happen, or what could be the source of the difference? So it could be due to price difference, it could be due to a volume difference, or it could be due to a different mix of what was there in the budget versus what you see in the actuals. Some explanations also might be that to get some quantity discounts or to avoid some price increases, you have preponed the purchases or you have postponed the purchases. That could be another reason for a difference, which is a timing difference, and that usually gets reversed. Any unplanned operational challenges that were not planned but that came across when you were actually going through the year. So any unplanned operational challenges, that could be another reason for your variances. Any assumption that you had made in the plan that was incorrect. So then you have to point out to that assumption that, okay, this is the reason we are away from the plan. We had assumed X, but actually the assumption turned out to be Y. Changes in market trends or conditions. When you had prepared the budget, the market conditions were different. Right now, when you are actually doing the commentary for your month end, the market has changed, the conditions have changed. So these are some common explanations that could be possible. However, not an exhaustive list, just so that you get some idea of what could be the different reasons that you could use as variance analysis commentaries. Okay, so we move to the next question, which is a very logical next question. How far are we from the actuals? Okay, and what actions should be taken now? Now that the actuals have materialized, what should we do in the next period, or what can we do to improve in the next period? So should we suggest cutting back? Should we suggest to shift some budget from the other department to this department, or from this expense line to the other expense? How could we reverse the harm done, cover up overspending by making up the lost revenue? So, what could we do now to cover up the harm, or what could we do to reverse the harm that has been done? So, this is the second question, which is how far apart are we from the actuals, and what action could be taken next? Okay. Then the third and the final question is, what have we learned from this for the next budget or for the next forecast cycle? So this is an important question that will help you in your next budget or your next forecast cycle that you're doing. So you maintain a list of all the variances that you have seen in the historicals. Make a note of things that you've forgotten to budget, and make sure when you do the next cycle of the budget or the forecast, you go through that list and you make sure that you don't repeat the same mistake, or you update those assumptions wherever the assumptions have changed. So these are the three questions that you should be asking. First is, why did this happen? What could be the reason for the difference? How far are we from the actuals, and what can be done now? And then third is, what have we learned, and what could we do better in the next budget or the forecast cycle? Okay, that brings me to the 5 why technique, the technique that I. So in the DERB framework, this is the E part or the explanation part. So if you want to go deeper into the explanation or the business reasons, as Dhaval mentioned in the earlier slide, that you need to provide, you don't have to provide accounting reasons, you have to provide business reasons. So this is how you get to the business reasons. And this is one of the techniques that you can use. Okay. So a quick example of a 5 why technique. Before that, let me just give you a quick background. Okay. So the 5 why technique is a very popular technique, which is where you ask the question why 5 times to get to the root cause of any variance or any problem. Okay, so in this case, you are doing variance analysis. So you are trying to get to the root cause of any variance. That's why it is called the 5 why technique. So you ask the question why 5 times. Let's see, take a look at an example. So let's say your revenues are behind plan and you ask the first question looking at the revenue number, why are the total revenues lower than the plan? So that is the first why that you ask. Now you figured out from the data that you have or the Excel dump that you have that the revenues from this particular XYZ department is lower than plan. There are 5 different departments, but the remaining 4 are doing okay. This XYZ department is the one causing the overall revenues to be lower. If this had done okay, then probably we wouldn't have had such a big variance. Okay, so you figured out where it is coming from, or the first question that the first why you had asked, that answer you got from the data. Now you ask this another why, which is the second why. Now you figured out it is coming from XYZ department. So now you ask why are the revenues from the XYZ department lower than plan? Okay. So now you cannot figure this out from the data. Maybe you need to reach out to somebody in the XYZ team and ask them why did this happen. So then you ask somebody in XYZ team, and then they will look at more data or more granular level data, and they'll look at the pricing, volume, etc. That is the reason that the revenue is behind plan. You went one level deeper. You should not stop here. You should continue asking till the time you feel that you've reached to the business reason of the variance. Okay, so why did we offer so much of discount? Okay, then you get the answer on the third why. Let me check with somebody else in the team. He goes back to somebody else in the team, in the sales team, and then the sales team will tell you we ran a sales promotion for this particular product. And then you'll ask why did you run the sales promotion, and then you'll get another reason from the factory team saying that there were so many old inventory lying, and if we had not cleared them, they would have become obsolete. So that is why we had to clear them, and that is the reason we ran the discount. Okay, then you reach to the root cause of the problem, which is that there is very little demand for the product. So we had expected a lot of demand for that particular line of product, but that was not true. That is one of the assumptions that you had made in the plan or the forecast, which was not true. And that is the root cause or the business reason. Okay, so now you should bring this reason to your commentary and recommend, and then you have to figure out what do you need to do as a recommendation. So you might recommend many different options based on your business understanding. Okay, so for one example, you could recommend that we should stop producing this particular product because there is no demand for it. Okay, another recommendation could be you could probably make some changes in this product feature so that it becomes more relevant. Okay, so based on your business experience, you might get from the E to the R and then to the P. So this is the E part of the DERP framework, where you use the 5 why technique to get to the business reasons of any particular variance. You have to ask it 5 times, but you have to ask why more than once till the time you feel that you get to the root cause of the business, the variance. Okay, so
Yeah.
with that, let me take a pause, see if there are any questions.
So
So
there are a couple of good questions, Asif. We should take them
yeah.
right away. So there is one question about what are some of the KPIs that directly affect revenue or expenses. So when it comes to revenue or sales variance, basically you can break them down into price and volume. And under price, there could be certain discounts, right? Or under volume, there could be either directly quantity of sales or it could be market share. So you can deconstruct the volume variance into further, KPIs, and there are a number of KPIs to do that. So that's the quick brief that I wanted to share. Impact will always be a combination of price and volume, right? So price and volume variance. It will be a combination, and it may not always be necessarily only price or only volume, right? It will always be a combination. Expenses could be anything. Expenses, for example, let's say if I have a quarterly budget, marketing budget of $5 million per quarter. But I can come across a certain promotional event or some strategic marketing event that I want to be part of. I want to spend $10 million on this in the first quarter itself. And then seek approval from the marketing director, the CEO, whoever, to kind of readjust what I want to spend over the next 3 quarters, right? That is always possible. So no variance is good or bad. It doesn't mean that you have to exactly follow the same plan. That's not how it is. You need to run it. You need to do certain things. One other question was about COVID. How do we handle the numbers like this? See, again, COVID is a black swan event, right? So nobody can plan for that event. But yes, when we were actually doing a budget or a forecasting exercise, we had a full-blown budget, and by the time we reached February in that financial year, we saw that everything is going for a toss, right? So none of it, lockdowns, and next 3-4 months we couldn't predict anything reasonably, right? And that's a black swan event which nobody can plan for. But of course, you can take some corrective steps. You can cut back on certain non-essential expenditures. You can cut back on discretionary spends, and there are ways to kind of manage those kind of scenario as well. Asif, maybe you can take this one. Let me read it out for you. In most of the organizations, period and expenses booked through our auto reversal accrual entries, because of which it is difficult to compare month-on-month variances. How do we analyze such variances?
I can hear you, but I'm just trying to figure out what the context is. Okay, most of the organization period and expenses are booked through period end expenses. So these are probably your accruals, right? Your period end expenses are accruals, and yeah, that is what it is, because of which it will be difficult to compare. So accrual entry might have like 5 different invoices or 5 different expenses, right? So you cannot do variance analysis on accruals. You have to do it by line. So if the accrual is related to, say, salary or travel, then you have to consider that part of the expense in the salary, that part of the expense in the travel, and then you can do a comparison. You cannot just compare the accrual entries as while you are doing the variance analysis. When you compare the expenses, your accrual should be part of the expenses for that particular period.
Okay. So one point about the auto reversal entries, right? So I mean, if they are a material impact, then you may still have to include it in your report, even if it's an accounting variance. But as long as it's a predictable one and you know that it comes every month and gets reversed on the first of it, and it will get accrued at the month end. So maybe the variance could also be because you missed to accrue it on the next month or the subsequent month. That could also be one of the reasons. So you may have to just look into it and then explain that variance accordingly. It's not that you cannot explain an accounting reason. But generally, the business doesn't care about accounting reasons, right? It's your problem. Okay, so now that we all have learned a little bit about defining the variance, explaining the variance, trying to get to the root cause of the variance, one of the popular ways to explain the variance analysis or present the variance analysis is a waterfall chart, right? So what is a waterfall chart? Now let's look at it with a quick example. So let's quickly cover it with a small example. Now I want to understand the variance between 2023 profit and 2022 profit. Now, after digging into the reasons, I was able to find out that there is an impact of price increase of 100K, higher staff cost, a negative impact of 20K. The landlord has increased the rent, that is minus 25K. So compared to my 2022 profit, there are some positives and there are some negatives. And that's how I'm reaching my 2023 profit of 205K, right? Now, a simplest, most of the times what happens is that when you're explaining or presenting the variances to the business counterparts, they don't understand Excel sheets like we do, right? So a lot of the times you have to use a visual medium to explain to them in a very simple manner. So that's why a waterfall chart does a trick. If you just select the data, go to recommended charts, it will recommend a waterfall chart. So you can just go for a waterfall chart and then just click on OK. It will give you a certain waterfall chart. You click on this last bucket and then say set as total. And now this gives you the total as well. So you can, of course, change colors for this if you want. So maybe I want all the positives to be green and maybe all the negatives to be in red. All the greens represent positive variances. All the reds represent negative variances. The gap between 2022 and 2023 profit is that there is a positive impact of price increases on our products, which contributed 100K extra to our profits. However, we used some higher staff cost more than planned. That's why there is a negative 20K impact. And also the landlord increased the rent, which is probably not budgeted for, or maybe we bought some extra space and we had to accommodate that. So that's why there's a negative impact of 25K as well. So this is how you have explained the variance between 2022 profit and 2023 profit. You can use the same technique to explain any two variances between actuals and budget, between forecast and actuals, at current quarter versus previous quarter, whatever 2 points in time, 2 points of variances you want to explain, it will be, you can explain it as long as there are certain positive and negative reasons, and you can explain that through a waterfall chart. Okay, so waterfall chart is one of the most popular ways to present variances or explain bridging the gap between 2 points. Very useful for FP&A professional to explain certain variances.
So there's a question. I would like to know why most of us use waterfall charts. It's because it's easiest for you to explain it to any non-finance person. So if somebody is not having finance background, especially sales, marketing people, they understand that waterfall chart better than any other chart that you present, because it's very easy for them to figure out the different parts of the variances.
See, one of the duties of all finance professionals is to make your business counterparts' life easier. Okay. Most of the times, what I've also done is I've not even sent the Excel sheet to them. You can explain it in Excel sheets, but most of the times, what I've done is what has worked for me is that I have put this simple chart or a table in the body of the email, and I've sent it to the business lead, and they have seen it on their mobile or on the go whenever they want to, and they have come back to me for questions. If you ask them to open an Excel sheet, go through tons of lines, and then come back with some reasons, they will not. As simple as that. Okay, so let's move to the next section. And I think sometimes it's easier, for us to use it. Sometimes it is difficult for us to use AI tools. ChatGPT can also be sometimes moody. But yes, I think 2x2 matrix is one of the best ways to present any variance between 2 points. So that's the point that we wanted to make. Okay, now that you have some understanding of variance analysis, right? So you realize how amazing it would be to learn all the high-paying skills related to FP&A, not just variance analysis. Working in FP&A, partnering with the business to explain, and help them take certain decisions, right? FP&A roles are always about supporting the business, right? What we have done is we have spoken to dozens of CFOs, and we have identified 5 critical skills that today's CFOs are looking for, right? And what are those skills? First is core FP&A concepts, right? You need to understand the basics of budgeting, forecasting, variance analysis, gross margin, net margin, fixed cost, variable cost, profitability, scenario planning. All of those are core concepts of FP&A that one needs to understand. And then there is financial modeling, right? Financial modeling specific to FP&A, where you are looking at the discipline of how do you build your models, scenario planning, what if analysis, all of these kind of things, which are essential financial modeling skills. The third skill is data storytelling. Like I mentioned to you, that business counterparts do not understand Excel sheets like we do, right? So we need to use the right chart types, the formats, and data storytelling is not about building some complex dashboard with a lot of buttons here and there and trying to use every space available on the screen to give some button or a drop down or something like that. That's not data storytelling, right? It's how effectively you can communicate your story about the numbers to the business teams. Business partnering. In business partnering comes at various levels. It's all about influencing the business teams, right, to take certain right decisions. Now, it could be in terms of pricing, it could be in terms of their cost management, it could be in terms of some proactive budget recommendations, whatever the case might be, right? So there are tons and tons of cases of business partnering that you can look for. And that's what finance professionals are expected to do, right? We are required to partner with business. Leverage AI and all the latest developments that are happening in finance. It could be anything in terms of data analytics tools or any of the AI tools like ChatGPT, Copilot, whatever is coming there out in the market and still developing. I would say still, we have just opened the gates of it and we are still yet to go inside the world of AI. So leveraging AI and keeping on being on top of all the developments is something which is expected of you, as that's what CFOs are expecting. Now, how can you master all these 5 skills, or how can you touch upon all these 5 skills and learn it, right? So what we have done is we have kind of simplified the stuff, and you might be thinking, okay, how much time would it require? Does it require hours and hours of efforts from my end? Will it require a year for me to kind of acquire all these concepts? Not really. So what we have done is through live lessons, through live online lessons, we have simplified all the content, the explanations, right? And every week we come online live for 2 hours. We train on multiple topics, right? It could be FP&A, financial modeling, AI, right? And 2 hours of commitment is all we need every week studies. So between Asif and we have more than 2.5 decades of business finance and FP&A experience. So I have worked with sectors like oil and gas, software, advertising and PR, commodity trading. Asif has worked with pharma, banking, edtech, right? So we have diverse experiences. And what we have done is we have tried to bring in as many real life scenarios as possible and make all our courses and masterclasses very engaging and real life like. And you also get certification from FP&A Professionals Institute. It's an independent body which will certify all your skill sets basis the trainings that we provide. We also provide support in terms of monthly Q&A sessions. Many times we bring in some guest speakers, experts, tool providers, right? Everything that you need for FP&A, we try and bring them to you. And you'll also have access to FPI's global community. The last time Asif and I kind of tried to analyze the student data, we saw that we have students from more than 35 countries, which we are extremely excited about. And you can be part of this global FP&A Professionals Institute community. And how can you be part of this? How can you learn more from us, right? So we have simplified all this into a methodical learning plan for you, right? And we have come up with 4 live courses. One is the FP&A Masterclass, which is our flagship program, which tells you everything about FP&A, budgeting, forecasting, management reporting, data storytelling, business partnering. All of that is covered in FP&A Masterclass. Financial modeling for FP&A, again, focused financial modeling, understanding business models, revenue models, scenario planning, all of that is covered in financial modeling. AI for finance and FP&A, leveraging latest tools like ChatGPT, Gemini, Copilot, having basics of Python in Excel, all of those things we cover in the AI for finance and FP&A. Tons and tons of use cases on ChatGPT, how you can use that in your day-to-day finance roles. Then finance leadership masterclass, right? It's not just about becoming a finance professional, right? So you have to also graduate to becoming a leader, not just a team leader, a finance leader who can manage multiple teams as well. So that's what we cover through our finance leadership masterclass. And apart from that, we keep conducting tons and tons of boot camps, workshops. It could be tool related. It could be any latest topic that's going on in the market. So all of those things we keep covering, right? And you'll also get access to all the FPI alumni group, right? So the pro membership, which has all our recorded programs as well, which has all our live programs as well, and this methodical learning plan. So over the period of 1 year, if you are able to just focus on these 4 to 5 courses, you will be complete in terms of your financial knowledge. You will be complete in terms of your FP&A knowledge, right? So that's what we have tried to attempt through these live courses. And you don't need to take all of them at one go. They are scheduled at convenient times on the weekend, designed for working professionals, usually on Saturdays, either mornings or evenings. And we'll give you a personalized learning plan for as to when and what course do you need to take. Now, what we've done is the simplified membership plan where you can enroll in any of these courses, right? Individually, the value of it is easily more than $1,000. And we used to sell them all individually. But we thought, why not simplify it for our students? Let them get all these critical skills that we spoke about by talking to dozens of CFOs. Let them take benefit of this, right? And we will keep conducting sessions, and they can enjoy the benefit of the learning plan, and they can take benefit of all these courses. And the pricing for all these courses, just for a limited period of time, is only $297. Individually, these courses are priced, some of them are priced $347, some of them are priced $247. But for a limited period, right, only for this month end, we are giving it at $297 only, all these popular live programs. And you can do these programs throughout 2025, at any point in time, whatever time schedule you like, right? And we publish our training calendar, and you can pick any time slot. Just let us know that, okay, I'm attending this batch, and you can just attend the live batch. Everything will be practical, live instructor-led, only for $297.
There's a question which is, would this cater to even a beginner or just advanced FP&A professionals? So this is targeted for beginners. So usually anybody who's new to FP&A, they usually undergo the FP&A masterclass and then the modeling. And leadership is for somebody who's looking to take the leadership or a managerial role. So these are more for the beginners. The advanced program is the 6-month certification for people who are already working in FP&A. So that's a CGFP program that you see, which you get as a discount once you complete all of these courses. So that is the advanced level program. So to answer your question, this is for people who are beginners in FP&A, but they have some work experience and they know a little bit of Excel and a little bit of accounting and finance. So although beginners in FP&A, but a little background in finance and accounting is what is required. Okay, so that is what we have. Maybe I can show them the timetable for the next
Yeah, Asif.
set of batches.
This is what we had to share. So we have simplified the entire membership plan. You can avail all of these courses at any given point in time at your convenience. We'll quickly share the calendar with you as well. And for alumni, right, so who have already taken one or the other courses, you may have taken masterclass from us, you may have taken modeling from us. If you have taken one of these 4 courses, all you need to do is pay only $197 for all other courses. Even if you have to individually buy these 1 courses, it is easily worth more than 247, 347, as the case might be. But for our alumni, only for a limited period of time, this will be accessible at $197. And don't take our word for it. There are dozens and dozens of testimonials. We have trained over 3,000 students. More than 450 people have availed the masterclass. There are tons and tons of testimonials on our website as well, so you can go through them. And if you have any questions, Asif and I are always there to support you, and you can reach out to us, and we are happy to help you with your finance careers. Cool. With that, let me stop sharing my screen. So what we can do is we can quickly just take 1 minute to show them the calendar, and then we can start taking any questions if there are.
Yeah. So usually we have batches running for each of these courses on a monthly or a bi-monthly basis. So the masterclass runs on every monthly basis. So batch 16 will happen in January. And then this is the timetable for the first 4 months of 2025. And then you can see the timings as well. So that masterclass happens Saturday 8 a.m. to 11 a.m. That is going to be the timing for 2025. Then the AI for finance also happens on Saturday from 11 to 1, which happens alternate months. And financial modeling and the leadership masterclass happens on Sundays between 8 to 10. So you can see that two batches batches happen alternate month for each of the programs. So once you join the membership, we will ask you which programs you want to do first. Based on this form that we collect, the information that we collect from you, we will give you a personalized learning plan for the next 4 months. If you want to do it over the next 1 year, we can do that. You can do that as well. So you can choose to do one program every month or maybe one program every quarter, depending upon your convenience. Okay, so that is what the membership will give you access to. Thanks everybody for joining today, and we will see you again in one of the next webinars.